So this is weekly commentary 46. For this weekly commentary, my voice might sound a little bit different. I have a chest and a throat infection. Nonetheless, I'm still good, but it's just maybe for the next 2 weeks you have to put up with a bit of a croaky voice from myself. Before we go into any of the technicals, I wanna just go over a few things to consider for the start of the year. It's only been the first week of trading. First 4 days actually, because Monday was a bank holiday. Now, when January begins, right, what do new traders do? New traders and uninformed traders, right? Because it's not just new traders. There's guys out there that've been trading for more than a year and they just keep making the same destructive, mistakes, and they're not willing to learn, and they think I'll have it next time essentially. And what they do is they wait for the market to open and they try to trade in something like this, right? You see here, we had a leg up higher. Now, what I wanted to see was this, and I was guiding you guys through it throughout the week, right? I wanted to see us respect this order block, and this candle we displaced away from it, right? Now, why is this an order? Why was this an order block? We had down candles, and then we had a displacement above it. Now, once we get above and close above that candle, right? These two candles, because it's two candles, right? If it was just the one candle, it would be the one candle. You have a bullish order block to work on, right? And you see how this candle moved into it, and then Thursday displaced. Now, Friday done what? Just moved back into the range. And what was Friday? NFP. And I gave you guys the heads up about the NFP on the Snapchat private story and as well as Telegram. And I always give the heads up the weekly commentary before NFP happens. Now we're gonna go into the price action I'm expecting to play out, right? But for now, do yourself, the favor and sit on your hands. And I'll tell you why. Right now it's the 8th of January, right? January is the month you're waiting for sentiment to build in the market. Now we spoke about sentiment before. What is sentiment? You're waiting for the bigger players to, dictate a side and favor a side. Now I get asked a question that's commonly asked, is it institutions that's moving price? No, it's more complicated than that. The algorithm takes the orders and delivers the orders given a specific time like to work in. There's an intraday time frame to work in and there's higher time frames that it will work off of as well. Now, the orders that the algorithm works off of, yes, it has to be orders from, significant big players, right? Now, when I say big players, I'm referring to the smart money. I'm not referring just to hedge funds and whatnot, right? The algorithm takes the orders and it delivers it. Now, in this time of year of January, big players, smart money, they wait for sentiment to be built in the market. Now, how can we tell sentiment is being built up in the marketplace? Consolidation. Consolidation, or we can call it accumulation, right? I prefer to call it accumulation because that's what it does. It accumulates orders on both sides, longs and shorts. It creates a sentiment. Now, how else do we, right, as more informed and seasoned traders that I'm trying to make you guys into, how do we wait for a favorable condition to on the higher time frame to entertain a position? Because what we're doing is simple. We're waiting for on the daily and weekly a clear side to be favored, right, to then trade in that direction. For example, last year, the weekly commentaries essentially we were in a bullish DXY. And all these moves higher, we had a very clean one. We understood when we were in a retracement, for example, like this candle, we can expect a move back to 50%, make a new high, 50, retrace, make a new high. We're waiting for a clear side to be favored like that. Now, in here, it's not favored. What do we need to wait for? Wait for the sentiment to be built. Now, how can we understand that? Understand the economic fundamentals to an extent. Let January pass for most of January pass. The first week of January, you only have the FOMC and you have the NFP. This week coming, we have CPI. We want to see, these big economic folders. We want to see the current state of, the USD, and we want to see what the Federal Reserve want to do in terms of the hiking in rates, if they're hawkish or they're dovish. Now, they have said in the FOMC meeting that was on Wednesday that they have no, idea to slow down the increase in interest rate hikes. Now, that doesn't mean automatically you become bullish technically on the DXY. Fundamentally, yes, but technically for the next candles to print, no. We need to see a sponsorship of running sell side liquidity, right? We want to see sell side liquidity get run before we can entertain long positions on the higher time frame. If you're up to chapter 3, chapter 4 towards the end of the mentorship, or you keep up to date with the weekly commentaries, you know that we have on an intraday level the Asian range. You know, the daily anatomy is well for the CBDR, the Asian range, and then you have your, your liquidity delivery given London and New York. The quarters of the year are very similar to that, right? Treat January like it's the Asian range, right? CBDR slash Asian range, you could say. The higher time frame, remember, we're looking at the quarters. Now, the next quarter is going to be the 1st of March, right? This, you know, December, now we're going into January. What you're waiting for in the higher time frame is a Judas swing, preferably, right? December usually is the one that consolidates, and as you can see, December did consolidate, right? This, if I go to the 1st of December, this is the 1st of December, and this is the candles from between it. Now, I'm waiting for a Judas swing. Now, we went higher. Where are we likely to print? From the next daily candle, right? You can see that it's probably going to target sell side liquidity. These lows are still relatively equal. Remember from the weekly commentary we done last week, we were looking for the move into here. Now, I want to take your attention to the 3-month chart. Focus on this imbalance here. Now, if I take my fib tool and I mark it up here, now, why am I doing it from here? What's this range showing? This is consequent encroachment. 50% of this imbalance created in this candle, right? That's what we're looking for. I'm not looking at this one because this one is in line with this consolidation here. This one is the one exceeding this consolidation. I'm looking at this candle. I want to see a retracement into the consequent encroachment of this 3-month candle. Now, this 3-month candle, if we take that and keep it on there, we can see where it lines up with around the monthly, right? It's inside this order block. Give or take this area, I want to see we trade into. Not specifically just into the 50%, but give or take this area, I want to see the retracement into, right? You can see early on in the month, now we've seen that we shot up higher, and this could be a reasonable high of the month. Why could that be a reasonable high of the month? Going back to the weekly chart, I'm just going to remove the fib just for simplicity's sake. Now, 1, 2, 3. Remember we had that trend line built up. If you look at the highs of these candles, right? 1, 2, 3, 4. There was no disruption. Remember, I think it was 2 or 3 weekly commentaries ago. We spoke about how there's only been buy side kept intact for 1, 2, 3, 4, 5 weeks. And now we had a run on buy stops. We want to see price deliver them lower. Now, it's very common. You're going to see both sides get taken out. Higher, drive it lower, and come back into the range. Essentially, that's a seek and destroy model. What is a seek and destroy model? When you have a range built up and you take out one side, and then you take out the other side, and then you come back into the range, you're eliminating buy stops and sell stops, seeking and destroying both parties of that range, the buyers and the sellers. You're taking them both in, and now they're being essentially strangled within the consolidation. They're both going to be in a drawdown. Imagine your buy stop is above here and your sell stop is beneath here. Price runs it here. Now you're entered in on a long position. You have a sell stop beneath here as well. Price goes down and it takes your sell stop. Now you have a buy and a sell. Or we can say that the buy is above here and the sell is beneath here. And then the market comes back into the range. They're all going to be in a drawdown here. And essentially it's just created a large level of, liquidity that can be countered for smart money because both parties are involved within the range now, right? Now, if you go to the economic calendar, we have the chairman speaking on Tuesday, and I believe it's Thursday with the CPI. This is the one you want to see because then we have FOMC what they want to work off. Now, if CPI, if what is CPI? In chapter 5, I teach what the CPI shows, the consumer price index. It's a measure for inflation. Now, if the CPI is, increasing and inflation is increasing, It fits the narrative. Now that's what we're doing. We're waiting for sentiment to create a narrative. And we're waiting for what, you know, the Federal Reserve for the USD, for the US economy, are likely to do with the data that's announced for the CPI. Is it going to fit the narrative of we're looking to increase the rates further? Because they're already saying that they want to do it. But can this just accelerate it, or can it, you know, kind of amplify how much they want to increase the rates by? Do you see how letting this time go and building your narrative, building your understanding of what they want to do is going to help you, right? Because the actual economic fundamentals, they don't automatically and immediately point towards the technicals, right? It tells you where price is likely to go overall. For example, they're hawkish on the rates. They want to increase the rates. The CPI comes out greater, and that complements the idea of hiking rates. But before they hike the rates, which will turn the bonds and the bond yields and the DXY bullish, the technicals need to do what? Probably run sell side liquidity. So let's talk about that, right? We still have we still have this fair value gap to work on, and we have this sell side liquidity pool here. Watch this area, right? From this fair value gap and here, what we're waiting for is we want to see a move into your array and then a market structure shift away from it on the higher time frame. Preferably, I want to see this towards the end of Jan, right? So this week is going to take us towards the middle of January. The third week is when it gets interesting, right? The last week of January is probably going to start moving towards its intended direction, in my opinion, for February and March. This is what I'm waiting for. Now, from the next weekly candle, I'd favor shorts on the DXY. Now, looking at this and the US 10-year, we failed to make a new high, right? We came up optimal trade entry here, right? One, two, three, four down candles. This on a high time frame is going to make one level of imbalance because it's this down candle after down candle, right? Sorry. If we go to the 4 hour, we can see there's a market maker sell model. We have an initial consolidation and we're running the highs. You see here this trend line, we run these highs, right? And now we have the sell side of the curve being offered, and we target this low for the bonds. Now, on the daily, is this sell side liquidity pool being here. Now, softer bonds is gonna make a softer DXY, and we're pairing the run into that weekly fair value gap, but consider the run on that low. If the bonds are very soft, right? What do I mean by soft? As in weak, they're gonna roll over to the downside. Watch this run on this liquidity pool here. Now you can frame, right? If you're short on the DXY to here, you can frame longs on euro, right? You can see where euro is trying to push up for. Now, in my opinion, GBP USD is the cleaner pair to trade. If we look at euro GBP, right, we can see that we swept the previous day's high on Friday. The next daily candle is likely to print lower, and we have this level of imbalance still to fill here. We have sell side liquidity pools being here, right? From here, this candle and these candles, it's quite flat. You see retail, they'll see that as a strong support level. That's going to get traded through. Now, that is showing strength in the pound, and we're expecting a weaker dollar. GBP USD is going to offer the stronger buy, right? Now, we got above this candle. Now, this is your bullish order block that you can work off of. So if you want to, you can highlight this candle, right? And frame retracement down into it, and you're waiting for, given time of day, for example, Asian range accumulation, manipulation, and you want to see distribution away from it. Target this level of buy side liquidity, right? You can have longs up until then, and you can pair it with the run on here with the DXY, right? The DXY to go down beneath these lows, GBP USD to go above and break this, we haven't tagged this buy side liquidity pool just resting above here yet. There's a buy side liquidity pool up here and here. One target at a time. Don't expect this to be traded through within a day, right? This is your ultimate draw on liquidity, being long on GBP USD. Is one daily candle going to take you there? Probably not, right? You're taking intraday trades every single day. You're expecting, the open, low, high, close, right? Accumulation, manipulation, distribution, a power of three to the upside every single time, right? That's what you're hunting. Now, a question I get about the accumulation, manipulation, distribution, power of three model is this. I get asked quite a lot. I expected the day to be bearish, and then after the Asian range, I saw that we just moved down lower and we didn't have that Judas swing higher. Now, what you're waiting for is this. You can have a move lower first. Totally fine. That happens. You're still waiting for that run higher. And I'll tell you why, right? We'll just do another little demo. Now, let's say it's a daily candle. The daily candle takes, a whole day for the open, low, high, and close to form. Open, low, high, close, right? What does that mean? Open, you make the low, then the high, and then the close. That's a bullish candle. But it doesn't mean that, it opens and then it can trade a bit higher. We're talking about when the low and the high is made. Do you see the point I'm making? You can have a candle that opens, right? So if we just have a trend line, this shows the candle open, right? And it's going to be a bearish candle. Then you can have the candle look like this, right? It trades a bit higher. It trades a bit higher. I don't know why it's doing that. And then what you get is this. It trades lower, right? It trades lower, and that's the low. And by the end of the day, it'll be a bit, yeah, it'll be a bit better if I made it like this. And then by the end of the day, it will look something like this. So this is the candles open. Now, this, right, the bullish candle, it automatically trades higher. Now, that, bear with me. I'm going to draw a path tool now. This can look something like this, right? So this is your Asian range, the opening, right, of the day, because it's 8 p.m. to midnight time. That's your opening, right? The Asian range is basically the opening. It's from 8 p.m. to the opening of the candle. Now, then you can see something like this, and you're expecting a bullish day. And this throws off a lot of traders because they're expecting, I'm expecting a bullish day, and it's taking out the Asian ranges high. And a lot of misinformed traders, they don't even consider it. They go purely off the Asian range and what side it takes, and they'll think this is a bearish day. And then what happens is it comes down and takes the Asian range low, right? And then it just trades up higher. You see how this is the opening, right? This first part is the opening. We're expecting a bullish day. You see how we trade here, but this isn't the high of the day. This is not the high. This is just a candle trading. Have you ever seen a minute one candle forming or 5 minute candle forming in real time? A bullish candle, right? It can trade higher, right? It will open and then straight away may trade higher and then it'll trade lower. And then the last 2 3 minutes of the 5 minute candle will then go and make the high of the candle. This is it essentially. It will go higher and then it'll go lower, making the low. This is what you're waiting for, your bullish day. And this comes with experience, and it's going to be a bit tough, and you have to experience it a few times for you to really understand it. You're waiting for this, and this is just being very, strong on your technicals and your understanding of price, what you're waiting for. The daily candle is like to be bullish. This is what you're waiting for in the lower time frame. This Judas swing. This one, you're not waiting for it. It doesn't fit your narrative. Forget it. This is just a daily candle doing this, just opening a bit higher, ultimately to go and make the low, which is this candle, right? And then you see how we're moving away from it here is this candle and this candle, right? The low being this being made, and then the high being made, like perhaps this one, and then this high showing this candle's high. That's what you wait for. I get a lot of questions, and this is very common and it throws a lot of people off. But this is how you treat it. You're always waiting for the Judas swing in your favor that's opposing your bias. It can go in your favor for the first point after midnight, but that's not your Judas that you're waiting for. You're still waiting for your retracement. Now, does it have to be under the Asian range low? No, it doesn't. Remember, you're waiting for, there could be a fair value gap left here, right? It could be something like this instead. It could come to 50% of Asia. If I just draw this again entirely, it'll be easier. You can just get something like this, come back into it. Now, if you see that there's a fair value gap that's being respected and, you're displacing away from it, you can expect a new high to be made and you can get long to break that high, right? Essentially, you can be in a market maker, sell model overall, and you're just trading the buy side of the curve. If the buy side of the curve is, convenient to trade, if there's time for you to hit into a higher time frame PD array, right? Now, for euro, I mean, I'd leave euro out of the mix, out of a pound and euro. It's just way too wicky and choppy. I think pound is the much favorable one to trade in this scenario. Um, these highs, right? They're still relatively equal. This high, even though it's been traded through, it's still two support resistance like. Um, so just to recap the weekly commentary, wait for sentiment to be built. I get asked a lot, when am I looking to entertain the market again? I'm looking to entertain the market again, preferably, if it's clear by the end of January, by all means the last week of January. Other than that, I'll wait till February. I'm waiting for a clear high time frame until I can tell whether one side is being respected clearly. For example, if we're just displacing down on the DXY and we come up to rebalance a level of imbalance and we're showing a open high low close delivery, I'll go in line with the DXY and I'll target these lows and these lows and these lows. But for now, I want to see if they're doing something similar to what they've done. For example, let's look at January from the last year, right? It'll probably be something similar. So you have December, right? The 1st of December, and then you see here, January, that Judah swing lower and then higher. They take out both sides of the range, you see, and then you come down lower and then you're displacing away. You're waiting for something similar. Now, go into this time, right? You'll see it's the start of February and you're seeing the displacement away from it. You're waiting for the narrative to be built. Now, the narrative to be built isn't our narrative. You're waiting for the narrative of the central bank and what the Fed want to do. And we're just, essentially taking their narrative and we're running with it because that's how they're going to deliver the price. Remember, we are just mimicking what they're doing. That's it. How they want to deliver price, we're mimicking how they want to do it and we're trying to get in line with the move. Wait for them. They wait for sentiment to be built. They're waiting for the releases. They probably know what they want to do with interest rates. They'll probably know the economic stance they have on the US economy. But they need to wait. They're bound to the time as well. They need to wait for numbers to come out. Now, whether I care about the numbers, what they are, I believe is all manipulated. I don't believe the numbers are what they show. They said, inflation was 9% or 10% in the UK. It was way more than 10% in the UK. Things like your normal groceries were going up by 30 odd percent, and they said inflation was 10%, which is, eyebrow raising to say the least. Wait for the CPI, right? Um, GDP, I believe is the week following that. You don't need to really wait for that CPI. We had the FOMC, we have the Fed speaking as well. We're waiting for the inflation rate and seeing how they want to combat it. If it needs to be combated, if not, then we can see blood on the DXY. However, I believe, we're going to see a lower DXY for the first month, which is January, going into the next few weeks. Let them want to increase the interest rates. You'll see by coming February and March, I believe the DXY is going to start pointing higher. Before they increase the interest rates, it's going to start pointing higher. It's not on the release of the interest rates. Remember last year with the bonds, we knew they wanted to increase the rates in September. So what did we know? We knew that, a month before on the high time frame daily, if we go to the bonds, right? This move here, we knew that they're gonna run the sell side liquidity pool in August, and what did they do? All in the run up to September, the middle of September, I believe it was around here. Then they announced that we want to rate that increase the interest rates, and then they ran it. But you see how they were running it before they even dropped it. Consider something similar on the DXY. Run that low and see them run up higher, right? Now that's gonna be it for this weekly commentary. I'm favoring longs on pound and I'm favoring lower prices here on the DXY, right? Um, for people that are asking when to take a funded challenge, like I say all the time, there's three criteria that need to be met. Are you confident? This is number one. I am not your validity to take the funded challenge. I don't know how you trade as a trader. You could show me you're profitable, but perhaps you're not, and you're just wanting to show me just to seek my validity. You don't need to seek my validity. The only thing you need is this: your own confidence. Are you in a financial position where you can take the challenge? That's a big one people don't consider. Are you financially, you know, in a place where you can take the challenge and lose it and it won't affect your life? Because if you're not and you take that challenge, automatically you're in a mental drawdown because you know you can't lose the challenge because it's going to be too much for you to take financially. And thirdly, wait for a higher time frame bias. Wait for yourself to understand to you one side is being favored. Right now, in my opinion, it's not. It's going higher one way, it's going lower one way. I'm waiting for one side to be favored. Now here, you can take the shorts here on the daily, and you can intraday trade that long on the pound, like we said. But preferably, I'd say wait till the end of Jan and Feb, right? For the people that are unfunded, respect your risk. There is no means to make money on that funded every single day or even every single week. You don't need to. Just because it's at your disposal, it doesn't mean that you always have to trade it. I'll give you a good example, right? We all have food in our house, right? I hope we all have food in our house, right? Because food is accessible and, it's there for us, doesn't mean that we're always eating it. No. We only eat it when we need to, right? The same thing with your funded account is similar. You don't trade it every single day because it's there and you want to. You only trade your funded account when trading is making sense for you, when the higher time frame is making sense, when there is a trade to take, not just because your funded account is there. You take a trade when there's a trade to take, not because you have an account there to trade, right? So bear that in mind. So that's going to be all with this weekly commentary. um Consider this sell side liquidity pool. It's way too clean and we had that fair value gap sitting down into it. We did exhaust that fair value gap a little bit. In my opinion, it was too shallow. I want to see like a bodied candle, right? What I like to see is I want to see like a bodied candle in here, right? And then move away from it. That's what I like to see. Even on the daily, an accumulation here, or like a 4 hour market make a buy model off that, I would entertain longs on the DXY. But for now, 1, 2, 3 weeks of sell stops, essentially the entire of December, long positions, short positions, sorry, that had stop losses, trailed, were punished. Buy stops above these weekly candles highs, punished. Expect that move lower, right? So that's all for this weekly commentary. And until the next time, I'll see you guys in the next one.